Welcome to Business Education and Research. This video explains the concept of financial leverage, its calculation, and the factors influencing the level of financial leverage. Financial leverage is a concept that revolves around a company's use of debt funds to boost the return on equity. In simpler terms, it is a strategy of using borrowed funds to increase the profits for equity shareholders. Financial leverage, which is also known as leverage or trading on equity, is a concept that relates to companies' use of debt or other fixed charge financing, such as preferential stock, to increase its return on equity (ROE). It is a strategy of using borrowed funds to magnify the potential returns to shareholders. The debt ratio, also known as the debt to equity ratio, measures the proportion of a company's financing that comes from debt compared to equity. A higher debt ratio indicates higher level of financial leverage. The formula to calculate debt to equity ratio is equal to total debt divided by total equity. This slide shows the calculations of financial leverage with an example. Suppose a company X and company Y both wants to invest in a new project that is expected to yield a 15% return on investment. What could be the situation here? So the details are given here. Company X and company Y details are given here. Please note that both companies is investing in similar project. So the cost of the project is 100,000 and similarly the cost of the project of company Y is also 100,000. Source of funds. The source of funds for company X is debt capital 50,000 at the rate of 5% interest and equity capital 50,000. So company X is mobilizing the cost of the project of 100,000 by two ways. Debt capital 50,000 by borrowing, say at the rate of 5% interest, and equity capital, that is owner's equity, 50,000. So 50-50. When come to company Y, to finance this 100,000 project cost, the company is going for 100% equity capital. It is not going for debt capital. It is going for 100% equity capital. So the entire 100,000 is mobilized by way of equity. What is the expected return on investment, ROI? As mentioned in the example, the return on investment of the project is 15% on investment 100,000. 15% on investment of 100,000. So translating the ROI in terms of rupees, profit from the project at 15% ROI is 15,000, 15,000. So 15% is calculated on the cost of the project 100,000. Similarly for Y, 15% projected return on investment is calculated on initial investment of 100,000 of the project cost. So 15,000 each is the profit. So less interest, that is the company has to deduct interest on debt capital. As already mentioned, only X company is going for debt capital 50,000. The company borrowed 50,000 loans at the rate of 5%, at the rate of 5%. So 5% on 50,000 loan, 5% on 50,000 is 2,500. So 15,000 minus 2,500, you get 12,500 is the profit available for shareholders. So the 12,500 should be distributed to shareholders as return on investment. So 12,500 divided by equity capital of 50,000 multiplied by 100, you get 25%. So therefore, the equity shareholders invest 50,000 rupees from their pocket and the company borrows 50,000 loan at the rate of interest, 5% interest. So when company makes 15% profit on the investment, so the amount of profit is 15,000. First, the company has to pay interest on the loan, debt capital. So 5% on 50,000 is 2,500. So profit 15,000 minus interest expenditure 2,500. The remaining profit 12,500 goes to shareholders. How much amount of money invested by shareholders? 50,000. Equity capital 50,000. So therefore, the remaining 12,500 after interest should be distributed to shareholders, let us say, in the absence of tax. So 12,500 divided by 50,000 into 100, you get 25% as return on investment for equity shareholders. When come to company Y, for the given situation, the cost of the project again here is same 100,000. So the entire money is contributed by equity shareholders. 100,000 is equity capital. There is no debt capital here. 100% equity. So 15% profit. So 15,000 profit. So there is no interest obligation because the entire capital is contributed by equity shareholders. So therefore the profit 15,000 goes to shareholders. Entire profit goes to 15,000. So 15,000 divided by 100,000 multiplied by 100, they get only 15%. When you see the quantum of profit, for X, the equity shareholders are getting 12,500, but on 50,000 investment. That's why the return on investment is 25%. Whereas company Y shareholders gets 15,000. The entire profit goes to them because there is no debt capital. There is no interest obligation. But the problem is the return on investment calculated on equity capital is 15,000 divided by 100,000 multiplied by 100, they get only 15%. So the company which is applying financial leverage using debt capital and equity capital is able to deliver more return on equity to equity shareholders, that is 25%, because this company is using shareholders' money as well as others' money. So just by paying 5% interest, remaining profit distributed to shareholders. So with less investment, equity shareholders are getting 25% return. Whereas company Y employs full in full equity capital. So the entire money is contributed by equity shareholders. So therefore there is no interest obligation. So 15,000 is distributed to 100,000 equity capital. So they get only 15%. So therefore the company which is practicing financial leverage is able to deliver more return on equity when compared to the company which is not practicing financial leverage. 15% is only the profit available for shareholders. This slide shows the advantages of financial leverage. Increased returns. Financial leverage allows you to amplify returns on investment. By borrowing funds at a lower cost than the expected return, you can potentially earn more from your investment. Diversification. Leverage can enable you to diversify your investment and reduce concentration risk. Instead of using all your equity for one investment, you can use leverage, spread your investment across multiple assets or projects. The financial leverage has few disadvantages also. Interest cost. When using financial leverage, you incur interest cost on the borrowed funds. If your investment do not generate sufficient returns to cover these costs, it can lead to financial distress. Risk of losses. Leverage magnifies both gains and losses. If your investment performs poorly, you can experience significant losses that exceed your initial equity investment. Now let us see the determinants of financial leverage one by one. Operating profitability. The profitability of companies' operations affects its ability to service debt. Higher profitability can provide a cushion to cover interest expenses and encourage more leverage. Industry and economic conditions. The industry in which a company operates and the overall economic conditions can impact its financial leverage. Some industries are more capital intensive and may naturally carry higher levels of debt. For example, airlines and utility companies often have high levels of financial leverage due to their capital intensive nature. During economic downturns, companies in these industries may face challenges in servicing their debt. The interest coverage ratio mainly influences the financial leverage. The interest coverage ratio is assessing company's ability to cover its interest expenses with its operating income. A higher interest coverage ratio implies lower financial risk and may encourage more borrowing. The formula for calculating the interest coverage ratio is earning before interest and taxes, that is EBIT, divided by interest expenditure. For example, if company X generates 200,000 in EBIT and has an annual interest expenditure of rupees 50,000, what is the interest coverage ratio? Let us apply the formula and find out. The company's interest coverage ratio is equal to 200,000 divided by 50,000, you get 4. 200,000 is EBIT 50,000 is the interest amount. So EBIT divided by interest obligation, interest expenditure, you get 4 as an answer. That is interest coverage ratio. That is 4 times. It means the company's earnings are 4 times of its interest expenditure. This suggests that company X can comfortably cover its interest expenditure with its operating income. The market confidence and growth prospects influences the degree of financial leverage. Market confidence. Investor and lender confidence in a company's ability to meet its financial obligation is crucial in determining financial leverage. A company with strong credit rating and a history of meeting its financial commitments may find it easier to access debt financing. Growth prospects. Companies that foresee significant growth opportunities may choose to leverage their balance sheet to fund expansion projects. The anticipation of higher future cash flows can make debt more appealing. For example, a tech startup with a groundbreaking product may select to use debt to scale up quickly, assuming if the expected revenue growth will comfortably cover the interest payments. The regulatory environment is also another important factor that influences financial leverage. The government regulations can influence the level of financial leverage of a company. Specific industries are subject to legal limits on the amount of debt they can carry. For example, banks and financial institutions are typically subject to regulations that restrict their debt to equity ratios to maintain financial stability. In conclusion, the determinants of financial leverage are multifaceted and involve a combination of financial ratios, market conditions, industry characteristics, and company-specific financial goals and strategies. Careful consideration of these determinants is crucial for companies and investors when deciding the appropriate level of financial leverage to employ their operations or investment portfolios.